Hey everyone, it's that time of the year where we go back and look over the past 12 months and review the performance of my stock portfolio. Now, this is something that I've done every single year since I started this channel. You can go back and look at any of the past videos after this if you want to, but this year was my best performing year ever. So today's video is going to be relatively simple. I'm just going to go through one by one each of the businesses, each of the stocks in my portfolio and talk about them a little bit as well as share their performance. I'll share my overall performance of my portfolio in terms of capital gains, dividends, and currency, and then overall. And finally, we will briefly compare the performance of my portfolio to some major indices, the S&P 500 and the All Ordinaries in Australia. Also, as I mentioned on YouTube, you can see how my portfolio has performed in each of the last 3 years while I've been creating YouTube content. But if you want to see a 3-year review where I look at overall how my portfolio has done over a multi-year period, then make sure you let me know by leaving a like on the video and then head down to the comment section and let me know that's something that you want to see. Before we get started, I am pleased to announce that the Learn by Example platform and community is finally reopening for very limited enrollment in January of 2021. If you're someone who has begun analyzing businesses following Warren Buffett's core principles that I talk about on this channel all the time, and you want to work closely with me to dive deeper into the process, then you may want to consider joining our community. You'll be joining a community of 300 like-minded investors. You get instant access to 50 hours of real stock analysis that I have done on real companies so that you can use them as examples in applying the process to any business that you want to invest in. You get a 4-hour crash course on valuation with exercises after each lesson. There are weekly Q&A live streams, and a feature that I most recently added is a search engine for the 35-hour catalog of past Q&A sessions, so you can literally search through and find every single question that I've answered from students over the past 2 years. And there's even more stuff. So if you're interested in learning more about that, there's links down in the description below to learn more about it, as well as how to sign up at the discounted rate that is available at the moment. There are 30 spots available, or I should say there was 30 spots available when I opened enrollment yesterday. Currently, as at the time of recording this, there are 11 spots left. So 19 of the 30 spots went in less than 24 hours. So if you're interested in this, make sure you jump on it quickly because the spots won't last very long. But other than that, let's jump into the video. So for the first part of this video, I just want to go through each of the positions in my portfolio in terms of the individual businesses, the ETFs, and any cash positions that I may have. And we're just going to start with the smallest position and work our way up. For some of these really small positions at the start, I won't spend too much time talking about them because I've said pretty much the exact same thing about them in the previous videos. But the smallest position in my portfolio right now is National Australia Bank. It currently makes up 0.7% of my portfolio, and for those who don't know, it's one of the 4 major banks in Australia. And as I've said in pretty much every single video that I've made covering my portfolio since the beginning of this channel, I'm just holding this position for sentimental value. It was the first investment I ever made, so I'm just going to leave it there probably forever and kind of see what happens with it over time, but I'm certainly not adding more to it, and it has stayed the exact same over the past 2 or 3 years really. The only difference is that it's progressively become a smaller and smaller percentage of the portfolio as the overall portfolio has grown. In terms of performance, of course, it's such a small piece and I'm not adding to it, so I don't really care about the performance of this business, but capital gains for the last 12 months, or for 2020, I should say, was negative 7.1%. Dividends were 3.5%. Currency gains was 0 because it's an Australian business. There's no conversion. And therefore, the overall return for this stock or for this business in 2020 has been negative 3.7%. The second smallest business in my portfolio is YY Incorporated, or I think it's actually called Joy now. And again, this is a position that I haven't added to in, I think, over 2 years. It's a Chinese company in the streaming space over in China. And when I invested in this company, it was a purely speculative investment. So that is the way it's going to stay. I'm not adding to this business. I'm not even watching it for annual reports or news coming out about it. I'm simply just leaving it there. It will progressively become a smaller and smaller part of my portfolio over time, but I have no intention of selling it or adding more to it at all. I'll just see how it goes. Maybe it goes to zero, maybe it goes up a ton. I don't really care at this point. I'm just going to leave it as a very small part of my portfolio. And at the time of recording this, it is 0.8% of my portfolio. So very, very small. Again, I won't spend too much time on this because there really isn't that much to say about it. But in terms of returns, capital gains have been 46.9% in 2020. It paid a 1.5% dividend. Currency has been negative 8.9%. And that's because the relationship between US dollars and Australian dollars, it was a US investment. That relationship has gotten worse. And then overall, the return has been 39.5%. The third smallest position in my portfolio is an index fund. And this is actually a new index that I added in October of this year. Now, this index is VTS. It's Vanguard's total US stock market index. So it tracks, I think, the top 300 businesses on the US market. And again, this is an index fund, so it is something that, of course, I will be looking to add consistently to over time. And really the main reason why I introduced this was because I previously had an Australian market ETF, but I do want to have a little bit more diversification for the ETF portion of my portfolio. So while this is still a much smaller piece than the other ETF that we'll talk about in just a little bit, over time, these two ETFs will probably end up being similar percentages in my portfolio, simply because I don't really rate the US or Australian market over each other. I kind of see them as both having the potential to do well. One may do better than the other, but over time, both of them should go up. At the time of recording this, that index fund is 2.5% of my portfolio, so very, very small. And as I said, it's much smaller than the other ETF that we'll talk about in just a little bit. But basically, this will be the foundation of my portfolio. You've heard me speak about this a number of times. Even when I'm investing in individual businesses, or even when I'm mostly investing in individual businesses, I should say, I'm still going to have about 10 to 15% of my portfolio invested in broad market ETFs to act as kind of a foundation and a hedge against my individual picks. So if my individual picks don't work out as I expect, I still have this consistent index fund, broad market tracking ETF or ETFs that I can consistently contribute to, that I can be confident will go up over time with the US economy, and the other one with the Australian economy. As I mentioned, I only picked this up in October, so the returns are kind of useless, but so far since October, capital gains have been 0.9%. It's paid a 0.4% dividend. Currency has been zero because even though it's a US index or tracking US businesses, it's on the Australian market. So therefore the total return is 1.3%, but again, it's just since October. So that brings us to the fourth smallest position in our portfolio, but more interestingly, it's the first business that I have deeply analyzed and is a business that I would love to have as a much larger position in my portfolio if its price got more appropriate. And this business is Facebook. So currently it makes up 3.9% of my portfolio. So it is very, very small. And the reason why it's so much smaller than some of my other individual picks that I have also deeply analyzed is because it really hasn't become cheap enough times like the other businesses have. For Facebook, the only time that it became really, really attractive on a price basis was in 2018. And that was a really long time ago. So while at the time it was a pretty considerable investment, I think maybe it was 10 or 15% of my portfolio. You can go back and look at the other videos and kind of see what it was. But since then, the other businesses in my portfolio have grown. I've added more cash to the portfolio and invested more money. So as a result, it's become a progressively smaller and smaller percentage of my portfolio. And that will likely be the case unless there is a significant crash in its stock price and I still think the business is strong fundamentally, then maybe I will add more to that position. A lot has also been going on with Facebook, and there are a number of things that have started to concern me about this investment, and not enough that I would sell out of it right now, but there are a number of things going on, such as the threat of Facebook having to break up their businesses in terms of Facebook, Instagram, and WhatsApp. And I know there's a lot of people making arguments that a breakup would actually be good for Facebook, but I cannot reason with those arguments because in my view, an advertising business, an online advertising business like Facebook is really a data play. They make more money when there is more data available for them to use to make advertising better for businesses that are advertising on the platform. And not having data from Instagram or WhatsApp or Instagram not having data from Facebook, in my view, that could only be worse for their business in terms of doing targeted advertisements And if their advertisements are do not have as much data available to make them really, really good at tracking, then businesses will get worse returns, and therefore that would be negative for Facebook's business. At the moment, there are a number of court cases going on with Facebook for a number of states in the United States. I think it's most of them actually, as well as the FTC, the Federal Trade Commission. So those cases will go on for a very, very long time, probably multiple years, but I will be watching that. And if I ever feel as though the uncertainty around Facebook gets too high for me to be confident in where the business can be in the future, then I'll be selling out of that investment. That's kind of one of the key principles, is I need to be confident that I can project where the business will be in the future. And if I think there's a high chance that I cannot reasonably predict how much cash flow the business will produce over the next 10 years, then it will be a business I no longer want to hold. In terms of returns for Facebook in 2020, capital gains have been 34.8%. They do not pay a dividend, so that was 0. Currency gains have been negative 13.2%, and therefore the total is 21.7%. All right, so we are now starting to get to some of the larger positions in my portfolio. This one is the 4th largest, and the business is Texas Roadhouse, which is a restaurant chain in the United States. And I first initially invested in this company in 2019. I only invested a very small amount because I didn't think it offered me enough of a margin of safety at the time, but I really enjoyed the business. I really liked the business, and I had far too much cash in my portfolio that I wanted to put some in the best opportunities available to me, and this was one of them. But in March, of course, naturally, the restaurant business was hit substantially by the pandemic, as well as some of the US restaurant restrictions around that time, and the stock went from about $70 per share down to $25 per share. So I was investing heavily around the $25 to $35 mark when it was down at those lows. And clearly the reason why its stock price went down so much is because people were worried about the uncertainty around the pandemic and when restaurants were going to open again. And if you're looking at investing in a restaurant business that has a ton of debt and is not very profitable and is losing a ton of money when they have their restaurants closed, then I would also be very, very worried. But Texas Roadhouse was not in that position. They have very, very low debt, and they have a terrific management team that has a history of steering their company out of crises. And therefore, I am very, very confident that they will be able to steer Texas Roadhouse as a business out of this pandemic to continue to grow in the future. And they also have a ton of opportunities to grow once the pandemic kind of subsides and normal levels of restaurant activity return. They still have a lot of room to build a lot of restaurants in the US. They have a lot of room to increase their sales at restaurants. They don't even do lunchtime servings for most days of the week. I think they only do it on Friday to Sunday, which means Monday to Thursday, they don't even serve lunch. And that's a whole new revenue stream that they can tap into at some point in the future. And then there's things such as franchise fees from their expanding franchisee network that is mostly international. So on an international scale, there are people opening Texas Roadhouse restaurants in places such as the Middle East and in Europe, and they can collect franchise fees from those successful restaurants. Texas Roadhouse makes up 6.8% of my portfolio, and in 2020, this was one of the best performing stocks in my portfolio. So in terms of returns, capital gains were 83.9%. It paid a 0.2% dividend, which is pretty small. Currency gains was an astounding negative 16.7%. There's a bit of a trend here, right? Negative currency gains on all of these US positions. So therefore, the total overall return was 67.5%. And I just want to take a moment here to talk about currency gain, because clearly over the past year, it has been negative for my portfolio overall. And the reason why is because the US dollar over 2020 got weaker against the Australian dollar. And that means that there's going to be negative currency gains on any investments that you have in the US over the past year. Now, over the couple of years before that, it was very, very positive. It was actually adding to the overall return. But I think the important lesson here is that you need to be tracking your currency gains, whether you're using something like SHARESIGHT, which is what I use. Link down in the description if you want to get 4 months off a yearly subscription. But whatever you're using, you need to be tracking currency because it has a substantial and material impact on your overall returns. And if you're not tracking it, then you have no idea what your real returns are. The third biggest position in my portfolio is the Vanguard Australian Shares Index, VAS. So this is the other index fund that I have that I'm consistently adding to. And at the moment, this one is 8% of my portfolio. So you can see that the two index funds add up to about 10% of my portfolio, right in that 10 to 15% range that I'm comfortable with having those index funds as a foundation of my portfolio. Again, there's nothing really too much to say here except that I'm adding consistently to these. I always set aside a certain amount of my income and consistently contribute to these to keep it as a certain foundation. And as I mentioned, talking about the other ETF, over time, these two ETFs will balance out to have a similar percentage in my portfolio. But in terms of returns, so this ETF in terms of capital gains was 8% in 2020. The dividend was 2.7%. Currency was 0 because it's an Australian ETF. Therefore, the total return was 10.7%. The second largest position in my portfolio is Corporate Travel Management. CTD is the ticker symbol. And this is an Australian corporate travel business. And it's actually a new investment that I made in February and March of this year. And similar to Texas Roadhouse, it was a business that was directly and significantly impacted by this pandemic specifically. And they're both, Texas Roadhouse and corporate travel, are both in industries that have a lot of dangerous businesses, really risky businesses like the cruise lines and the airlines and even Webjet and Flight Center that had a ton of debt on their balance sheets. So when flights were shut down globally, those businesses were in a lot of trouble. They needed to find new debt. They needed to raise capital by selling more shares, but corporate travel was not in that position. They had no debt, and again, very similar story. I really like the management team, and as a result, corporate travel management, even though its stock price went down substantially, they were actually able to go on the offensive during the pandemic. They actually made a significant acquisition that will likely add about 30% to their profits once their profits return to normal levels, which we still don't know when that's going to be, but they were on the offensive, while businesses like Webjet and Flight Center and the airlines and the cruise lines were scrambling just to survive, and they will be dealing with the ramifications of this for probably the next decade. Businesses like corporate travel that had no debt are in a really strong position to grow and gain market share out of the pandemic. I think the important investing lesson here is that it's not just enough to look at the damaged industries and invest in any business in that industry, right? You can't just look and see, okay, travel is down substantially or restaurants are down. Let's just invest in any large travel business. That just doesn't work, because if you just invested in the airlines, for example, or the cruise lines, you're investing in really risky businesses. So what you really need to do is, if you want to look in really damaged industries that are going through a short-term problem, which is often a good place to look for the businesses that are in a strong position and that are just getting dragged down with everything else. Because of course, corporate travel's business was hurt in the short term, but they had no fears about going bankrupt like all of these other businesses in the travel sector had. So that's kind of the lesson I think out of this, is trying to identify the really strong businesses in struggling industries that are likely to do very well over time. This business makes up 13.3% of my portfolio, and it was by far the best performer in 2020. In terms of capital gains, it was up 163%. It paid a 0.2% dividend. There was no currency gains because it's an Australian business. Therefore, the total return was 163.2%. And it was actually up far higher than this just about a month ago. It was up well over 200%. So it is quite volatile, and I don't know what it's going to do in the short term like any business, but it has done very well. And I think even at price levels right now, it's not as if it's become very overvalued. I think it's fairly reasonable for what the business is expecting to grow at, or how the business is expecting to grow over the next decade. So that brings us to the largest position in my portfolio, which has also been the largest position for, I think, about the last 3 years. And that is Thor Industries, the largest US RV manufacturer. Basically, Thor has had quite a roller coaster of a ride over the past few years. The stock went down substantially in 2018, 2019 due to the end of the RV cycle. There was a dip in retail sales, and that substantially hurt their business in the short term. Then, of course, they were initially hit by the pandemic. But something interesting that I actually didn't expect was that the RV industry, after a couple of months of the pandemic, started to have some of their best months in 40 years. July 2020 was the best month for RV sales in 40 years, which is kind of crazy. Clearly, a lot of Americans are choosing to holiday in the US, at least over the next couple of years, and as a result have invested in buying an RV versus, I guess, not buying an RV and then traveling overseas. And there are still a number of restrictions on where people can travel anyway. I invested most significantly into Thor Industries in March after the stock fell down to a low of about $35 per share, I think, which was incredibly cheap. Under my valuation at least. And again, similar to corporate travel management, they've been on the offensive because they're in such a good financial position. They made an acquisition just a month ago, I think it was, in another family-run RV company in the US that will expand their operations, and they made an acquisition a couple of years ago in a significant operation that gets them business in Europe. So I'm very, very happy where this business is, and I'm very, very happy that it is the largest position in my portfolio. It's currently 14.6% of my portfolio, and in terms of returns, it returned 56.7% in 2020 for capital gains. Dividends were 2.8%. Currency was negative 15.5%. So the total return was 44%. So if you've been calculating the portions of my portfolio as we've been going through this video, you would know that that added up to about 50%. And the reason why is because 50% of my portfolio is in cash. And before you kind of lose your shirt and jump down to the comment section and yell at me for having so much money in cash during such a good year, that number is a little bit misleading. Because in the middle of the year, so I did a review of my portfolio in June, or at the end of June. At that time, I actually only had 25% of my portfolio in cash. So the fact that I have 50% cash isn't really a representation of me staying out of the market. It's more a representation of the fact that my business did far better than I expected in the back half of 2020. And as a result, I just had more cash going into my portfolio than I could put into the stock market. If you took the cash, just the cash that I had at the start of the year in my portfolio, then I would have been about 90% or maybe even more than 90% invested throughout the year. And during the middle of the year, the cash kind of built up from me putting more cash into the portfolio to the point where I was still 75% invested. So I was by far mostly invested for most of this year, but cash has been building up, and there's really two reasons for that. I sort of explained there's money coming in from my business, but I haven't been piling it into the market because businesses that I want to invest in have just gone up in price. They're just not at prices where I'm really, really happy. Things such as corporate travel management went from $4.50 to $17, and it went up to actually over 20, but now it's at about 17. Thor Industries went from 35 to over 100. So clearly, if I was happy to buy it at 35, I'm probably not so happy at 100. Texas Roadhouse went from 25 to 80. So all of these businesses that I would love to invest in have just gone up so much that I'm not keen to throw money at them. And also the other reason is that I'm very likely going to be buying an investment property in the year 2021. So that's another reason why I've lent on more of the side of keeping more cash around in the event that I want to use that as a down payment to invest in a property. Of course, if the stock market crashes significantly next year, I will probably postpone those plans and put more money into the stock market because that's where I feel confident investing. But if that doesn't happen and my cash builds up even more, I will likely deploy that in an investment property. And if I do that, I'll be sharing that entire journey with my YouTube audience as always. All right, I know this has been a really, really long video, but we can finally get to the overall performance of my portfolio and compare it to some indices. So in terms of the stocks in my portfolio, so just excluding cash for a second, capital gains were 61.5%, dividends was 1.7%, currency was negative 8.3%. So the overall return of the stocks in my portfolio in 2020 was 54.8%. But of course, we do need to take into account cash, and it is going to be a little bit tricky to account for cash because so much was just coming into the portfolio throughout the year, particularly in the last few months. But if we just assumed that I was approximately 75% invested in the stock market, then you could estimate that my returns, including cash cash were probably in the mid to high 30% range during 2020, although I think that 75% invested is a bit of an underestimation because that even includes money that I put into the portfolio in the first half of 2020. But regardless of how you calculate my cash in my portfolio, I think I substantially outperformed both of the major indices in the US and Australia. VTS, for example, if we just looked at someone who bought VTS at the start of the year and just left it there, the total return would have been 9.5%. If you did the same thing for the Vanguard Australian Shares Index, your return would have been a measly 2.4%. And I know there's going to be people complaining about this comparison because you could say that some people would be dollar cost averaging throughout the year and that might look different. And some people will argue that I would have added more in March if I was index fund investing, but there's really never going to be a good way to compare to the indices. And I really don't think it's a good argument to say that you would have invested more in March after it crashed, because personally, with the people I was speaking to who were index fund investing, most people reaching out to me were telling me that they were selling their index funds in March because they were scared that the market would go down further. So it's a bit of a fallacy to look back in hindsight and suggest that you would have bought more when it was lower. But either way, there's never going to be an easy comparison to the indexes. You should just have your personal return that you're targeting on average over many years, and that should be your benchmark to compare your portfolio to. Props to you if you stuck around for this entire video. I know it's been incredibly long and I appreciate you staying around for the whole video. Again, if you want to see a 3-year performance of my portfolio, if you want to see me do a review of that, then make sure you let me know by leaving a like on the video and letting me know your thoughts down in the comment section below. But other than that, hope you guys have a great day and I'll see you in the next video.